Well, hello everyone, and welcome to your Daily Five. I'm Joe Duarte from Joe Duarte and the MoneyOptions.com, author of the best-selling Options Trading for Dummies and the Everything Investing in Your 20s and 30s books. If you like what you see today, please consider a subscription to my website, Joe Duarte and the MoneyOptions.com. Today, I want to talk about combining sentiment and liquidity indicators to trade market turns. So, let's talk about our sound trading principles first. Of course, as usual, always manage risk. That means never put any money in the market you're not willing to lose. Always prepare for the unexpected. Trade what you see, and we're going to talk about this in some great detail today. Don't fight the Fed, but also watch the market response to what the news is saying and what the Fed is saying. Don't fight momentum. Focus on capital preservation. Always build a shopping list. You never know when the market's going to turn around. Trade in small lots so you have more money to do more trades on the side. Adapt your time frames to market trends. Never let a winner turn to a loser. Always use those sell stops, and you will always survive to fight another day. All right, let's go make some money. Today's presentation has a simple goal. You want to prepare for those market turns. And what that takes is recognizing meaningful sentiment shifts. And then you want to identify the status of the market's liquidity and the directional momentum of the prevailing trend. You want to identify those trend changes early. And then you want to be prepared to pull the trigger. And I'm going to show you how to do all this today. So let's review a little bit. Why is sentiment important? Well, sentiment is the mood of the markets. And extreme sentiment precedes trend changes. So when everyone is bullish, you can expect that there's going to be some sort of market top or consolidation pattern. When everyone is bearish, you want to consider the fact that you're probably going to get a significant market bottom at some point in the not too distant future. And so what we want to do is figure out how to detect those changes in sentiment early so that you can get in the market earlier and get more money out of it. So again, liquidity. It's the lifeblood of the financial markets. It's the amount of money in the system that's available for trading or doing business. Momentum comes from liquidity, and high liquidity equals bull markets. Low liquidity equals bear markets. Now, I did a recent, very detailed video on liquidity, and we'll put a link at the bottom of the page for you guys to check that out in case you missed it. Now, what we want to do is shape our thinking patterns by this very simple phrase: if this happens, do this. If you think about this market in that way, you're going to be able to get better organized. So these are the keys to success when you start with if this happens, do this. All right. You always look for signs of changing trends. You always set up your indicators. You review them like clockwork every day, every hour, whatever your time frame is. You pick your trading vehicle for when the trend changes. Then you define your entry and exit parameters, and above all, have no fear, because if your indicators are good, you're going to make some money. So let's look at the really big picture here and connect sentiment and liquidity. Right? First thing we want to look at is the sentiment. Now, as you're all familiar with the CBOE Volatility Index, or VIX, okay, that's this up here, and that's sentiment. And what we see is that when VIX falls, because there's less put buying in the market rises. This is a New York Stock Exchange advanced decline line, my favorite indicator. And again, you see here that when the Federal Reserve started threatening to raise interest rates in December 2021, put buying rose, VIX rose, the market crashed. And so we've had this period where the Fed's been raising rates and the market has been falling. Note that over the last several weeks, we've had at least 3 important hikes in sentiment. You see the VIX has peaked here, has peaked here, and has peaked here. The market has tried to rally and has failed until a couple of weeks ago, when the market finally bottomed, and now it's rallying significantly. And of course, it's testing a key resistance level here around the 200-day moving average. But the bottom line is, when VIX falls, the market tends to rally. But let's look at this in a little bit more detail. You can see that the market had been failing all the way with every pop up in VIX over the last several months. That's because liquidity, as measured by the Eurodollar index, has been falling. So you can't have a sustainable rally, even if you have bearish sentiment without liquidity. So what's happened lately? Well, the liquidity has stabilized. You can see here that the Eurodollar index is essentially bottoming out. VIX has collapsed. Bullish sentiment has returned. The market has rallied. One last thing I want to look at here is the RSI indicator. And what we can see here is that the market is now overbought right around the 200-day moving average. However, normally that might be a bearish sign, but until VIX turns around and liquidity shows signs of more weakness, the odds are that we're going to have a consolidation pattern right at this area. So always look for those sentiment extremes and look for that liquidity to support what sentiment is trying to tell you. Now, let's trade the market. You always have that vehicle that you want to have ready to go when you get the right signals. One of my favorites is the ProShares Ultra S&P 500 ETF, or SSO. This indicator, or this ETF, moves at twice the rate of the S&P 500. Let's make this short and simple here. Okay, you remember that the advanced decline line has been dropping and SSO has been dropping as well. And you also remember that liquidity improved somewhere down here. Guess what? SSO rose. Now, let's look at this in a little bit more detail. When do you put that money in? Well, what you see here is that it went above the 20-day moving average, right around here where you have this volume by price bar. Okay, and so you can see that accumulation distribution is starting to rise right around the same time. It's not a bad bet to put some money in above that 20-day moving average. Maybe not your full stake, but some, because accumulation distribution is going up. That means that there's short selling. All right, you want to take money away from those short sellers, so you can put a little money in down here. Now, on balance volume, looks a lot like the Eurodollar index. It's not exactly robust, which tells me that there is a lot less buying than short selling. So we can see a bit of consolidation here, and guess what? There's a volume by price indicator here that's telling us that this is an important congestion point. So first amount of money you put in, 20-day moving average. Second amount you put in at the 50-day moving average when you get above them. And then you start looking for volume by price bars to tell you where there's congestion points where you might do a little bit of profit taking. So have your indicator set, use your stepwise entry, know your support and resistance, and you manage your risk with that ADI, on balance volume, and volume by price. So the bottom line is the Eurodollar index measures the status of the market's liquidity. When the Eurodollar index is rising, you got rising liquidity, money's coming in the markets. Falling Eurodollar index, you have falling liquidity, money's leaving the market. High liquidity, higher stock prices. Low liquidity equals lower stock prices. VIX, however, measures sentiment. Rising VIX is bearish. Falling VIX is bullish. But only when VIX and XED confirm each other do we get important changes in the trend. So you want to watch what the New York Stock Exchange advanced decline line does when these two things line up correctly. Then you pull the trigger on your trading vehicle. Well, that's all I have for today. I'm Joe Duarte from Joe Duarte and the moneyoptions.com, author of the best-selling Options Trading for Dummies, the Everything Investing in Your 20s and 30s book. If you like what you saw today, check out a free trial subscription to Joe Duarte and the moneyoptions.com. And remember, trading is uncertain. Always be prepared.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.